What's up, guys? On this video, we're going to talk about context. And I know for sure that most traders ask themselves, how do I understand the context? When it comes to determining which side of the market is more in control, how do I know that? And I see so many people that have this problem because they're thinking, okay, we have support, we have resistance. What does the chart say about the midterm and the long term? How do I know when one side is in control? How do I know when the side that was in control is no more in control and the momentum has shifted? In my experience, the easiest and most effective way to determine which side is in control is the daily chart. And I don't mean like, oh, we are in a bull trend, we are making higher highs, higher lows, higher highs, higher. No, I don't mean that. Everyone knows this. Even a 5-year-old kid knows that this is an uptrend. We don't care about that because it's so easy and, to be fair, not super useful. Because if we want to be able to trade inside ranges like this, we need to know also on a lower time frame which side is in control. Because guys, ranges like this last 3 months. So you can't just not trade for 3 months and just trade when the market is super low. I mean, you're wasting so many opportunities if you do that. So we are able to trade in different environments. So the question is, how do you know when longs are in control and when shorts are in control? And the answer is Bitcoin algorithm. Many people think, oh, the market goes up when people buy, the market goes down when people sell. Bullshit. Bullshit. Especially Bitcoin. I don't know about the stock market. I'm sure that in the stock market there are institutional people, market makers, as they call them, that move the market because there's so much more liquidity. But on Bitcoin, mostly the market moves based on the algorithm. What does it mean? That when the algorithm has taken enough liquidity on the downside, for example, which means that it has stopped out enough people that longed. So downside, they have the stop losses on the downside. Let's say, for example, here, for example, there are lows, the market goes down, people have stop losses on these lows, they get taken out, and then the market reverses. Why? Based on how the algorithm works, I know for sure that when the market has taken enough liquidity on one side, it's going to go on the opposite side. And the question is, how do you know when the market is done taking liquidity, taking stop losses? Liquidity and stop loss is the same thing. That's what I mean by liquidity. How do you know when the market is done taking stop losses? On the downside, for example. How do you know? Well, daily candles. Let's go more in depth into this concept, and I want to show you a few clear examples. First of all, I want you to imagine 2 hourglasses. Now I'm not going to draw the hourglasses because it's going to take me forever, and I'm not very good at drawing. But let's say that we have 2 hourglasses. Guys, this concept is super important. If you're able to think about this concept when you're trying to figure out the context, I promise you, it's going to help you so much. So we have 2 hourglasses. The first one is for bullish moves, let's say, which means that the market goes down and takes liquidity on lows. For example, it stops people out by taking lows in order to reverse and create a bullish move. And the market reverses when the hourglasses of the longs of the stop losses that is taken is full. When this hourglass is full, which means that the market has taken enough stop losses, it's ready to reverse. And then what does it do? It takes stop losses on the upside. And when on the upside it's done taking stop losses, which means that it's taken enough stop losses at the highs, then it does the opposite thing. It fills the bullish hourglass, and then when it's done, it goes bullish, and then when it's done taking the highs and the stop loss on the highs, same thing, and so on. That's how the market moves. It goes from one hourglass to the other one. And of course, depending on the context, sometimes one hourglass gets filled more quickly than the other one. For example, if we are in a bull trend like this, we know that the hourglass, the bullish one, the one that's for taking stop losses at the lows, it gets filled sooner than the other one because the market trends upwards most of the time. So it depends on the context. But that's such an important way of seeing things because the market is so repetitive. The algorithm is so repetitive. And I'm not saying it's easy. I'm saying it gets much easier if you clearly understand this concept. And the only way to understand it is to study the daily candles. Let's go in depth into a few examples. Let's say that we are down here. Of course, you might say, oh, in hindsight, it's easier. Sure, I mean, not really, because I've been destroying this past days anyway, so it's always the same shit, guys. If you want me to be very direct, it's always the same shit. So let's say here, big drop. Boom, big drop. We form a low. We have no information here at the moment because we have this low and then we came up. We can't really think, oh, that the move is over. You know, we might think that the move is going to be over soon, maybe. But after this low, we don't have much information. So what we know is that the next time that we're going to take the stop losses here on this low, that's going to be a place where we're going to look for a long, possibly a long-term long, possibly. And as you can see here, we took this low and then bounce, and we created this wick. See, this is a daily candle, body, and there's the wick. And the wick is long enough. So you might think, okay, we took the low on the left, and then we bounced up, which means that maybe the bullish hourglass is filled, and now we can go higher and fill the bearish hourglass. Now maybe the algorithm is ready to reverse, so we get ready to go for a long. And something very standard that I've seen so many times is that when the algorithm is ready to reverse, on the next candle, it creates a higher low. It creates a higher low, a daily higher low. And then you reclaim the daily open, and the rest is history. And we get this all day long. And it is so easy to spot. Even here, guys. I mean, then the following week, I remember trading this. This was, by the way, almost, I think it front ran slightly the golden zone here. And New York session, very strong, very strong. And then the following day, higher low. Long wick, daily open, higher low, reversal, and so on. We have so many examples. Let's pick another one. Here, I mean, there are like 1 million. Here, this was on Friday. How do I remember? Because I'm obsessed with the chart, guys, I'll be honest with you. I have studied every possible move in this chart. I know the time of everything here. I remember everything. This low was put at 11:45 p.m. GMT plus 2, if I'm not mistaken, or something like that, maybe 11:15, but it was 11 a.m., I'm sorry. It was in the morning, 11 a.m., maybe 11:35, something like that. And then the day after we formed this long wick, the day after, we placed this higher low on Saturday, because even the weekend sometimes offers reversal. If the algorithm is ready, whether it's Monday, Tuesday, Saturday, Sunday, it doesn't matter. If the algorithm is ready, it's going to do what it's supposed to do. Higher low, reclaim of daily open, and the rest is history. And even a few days ago, we took this low that was put on Saturday, 8 p.m. And I said in my previous videos that I didn't like this low because it was put during the weekend. And very often the lows that are put during the weekend, they don't hold. The weekend can offer moves, but internal moves. But usually the main highs and the main lows are put during weekdays, especially during New York time and daily open. Those two are the best sessions. So we took this low, and we might think, okay, maybe the hourglass is filled. Now we are ready to reverse and go look for stop losses on the upside. But then we got this low right here that was put on, I can't remember the time, what was it? 10:30 something? Not ideal. And the following day, we took the high again. And at that point, the algorithm was like, you know what? I'm done taking liquidity on the downside. I reclaim the daily open and I go bullish. That's what I did. As you can see, a few days earlier, same thing. Boom, low, next day, take the low, bounce back up, no follow through. It means it's a liquidity grab, it's a bullish liquidity grab. Great, the hourglass is filled, reclaim of daily open, boom, bounce. Same thing, next day, open, we took previous day high, we lose the daily open, boom, move down. See? It goes like this forever, guys. I mean, daily open, boom, lose, takes previous day high, it loses the daily open, boom, down. That's how the algorithm works. And this concept is so powerful when it comes to determining should I long, should I short, should I look for longs, should I look for shorts. So easy. I mean, because if you, let's say you didn't, for some reason you did a long here, for some reason, and then you wake up the following day, right here, randomly right there, and you see the previous day candle, took this low, reclaimed, the daily open and it was bullish, and you might think, okay, there are very good chances that the hourglass is done taking liquidity on the downside. So today, given the fact that the momentum is probably bullish, I'm gonna look for a long today. And you get it. You know, instead of going on the 5-minute chart and try to figure out like the order blocks or the 5-minute chart, or those things that don't really matter, daily chart gives you the context. And I mean, once you get used to it, so easy to trade. Long wick, take this low, liquidity grab, no follow through, bounce back up, next day, higher low, reclaim of daily open, the rest is history. It goes like this forever. Probably if you open the chart 10 years ago on Bitcoin, like 2013, the algorithm used to work the same way on this type of candles. I mean, this is such a precious concept because it makes your life insanely easy. When you just wake up, you look at the candles, and you already know what to do. And you know what? Sometimes you won't know what to do because the context won't be so clear. And when that's the case, you do nothing. You wait for 1 day or 2 days, you let the market unfold because you don't have to trade every time. You don't have to trade every day. You know, it's not that your doctor tells you, oh, you must trade every single day. No, you don't have to. If you're not understanding the context that particular day because it's not clear, you let the market unfold, you do something else, you go for a run, for a walk, into nature, whatever. You don't trade because trading in a stupid way and losing money is much worse because you create bad habits and you don't want to do that because they're going to be very costly in the future. This is just a taste of how the algorithm works. And I hope you like the video. Personally, I love this concept. Let me know if you have any question. Like the video, subscribe, and I'll talk to you next time. Thank you.